My name is Rick Roach. I'm a managing director and a chartered alternative investment analyst with Little Harbor Advisors, a sponsor of quantitative investment programs. If I had to distill the differences between fundamental equity analyst and quantitative strategist and boil down to a nutshell, it's probably two. Number one is that quants use the law of large numbers. Quants place many bets across markets. Quants typically will have anywhere between 400 and 4,000 positions, where a fundamental manager may have 30, 50 stocks. But I think one of the other essential differences is that quants are using these machines to mitigate human and cognitive biases. They're going to have machines screen, source, and select these positions, and machines determine, that is, their algorithms determine what to buy, and when to sell. One of the questions I've been asked is, how many quant funds are out there? Well, there are several sources that I've looked at to try to quantify the size of the market. Preqin says there's roughly 3,600 hedge funds that are quantitative focused, with anywhere between $500 billion to $1 trillion. Morgan Stanley did a report in the fall of 2017 looking at quantitative focused mutual funds. They found somewhere between $700 and $750 billion. So you have somewhere between a trillion and a half, maybe at the higher end, 1.7 trillion invested in quantitative funds with quite literally thousands of quantitative choices. There's another way to differentiate quants, knowing there's some 3,600 of them. It's to look at their styles or the flavors. Some funds are what's called micro quants, and a micro quant or a micro-based quant really uses something that was developed by this guy Edward O. Thorp. And Edward O. Thorp was one of the pioneers of statistical arbitrage. If you're a micro quant, what you're using are statistical arbitrage, or you might be using market neutral portfolios such as this guy Ed Thorp developed. Macro, you tend to find macro-focused quants among commodity trading advisors. They're so-called systematic traders, and they may be using risk parity, and they may be searching the globe, whereas your micro-focused tend to use equities or equity indexes. Your macro are more likely to use futures contracts. In looking at the quantitative investment space, very few quant funds, though, have incorporated end-to-end AI. Bloomberg did a survey in the fall of 2017 and found that only 18% of asset managers have incorporated artificial intelligence and big data sets. Most quant funds use what's known as small data, not big data. In fact, most quant funds some have looked at it, the process, roughly a quarter have looked at the process, a quarter have said they're aspirational, they have a desire to do it, but they haven't done anything, and 1/3 of quant managers just haven't looked at this space at all. So again, when you look at those quant investment funds that have applied end-to-end artificial intelligence and big data sets, it's still a relatively few group of select managers have done that. What are some of the benefits of quantitative investment managers? I can think of three that come to mind. One, again, I've already addressed this. They place many more bets so that they have a much more diversified portfolio. A second is, you want to look at a quantitative investment strategy in the context of traditional stock and bond portfolios. If you have a client portfolio that's mostly 60% equity and 40% fixed income, you would want to add a quant strategy because most quant strategies have low to negative correlation to traditional stock portfolios. The third one, again, is a disciplined investment approach. What you want to do is try to remove some of the emotional elements out of investing. You can do that if you find a capable, qualified quant who's using their algorithms to go select and size positions as opposed to using their gut instinct. When it comes to drawbacks of quant strategies, of course there are some. One is that models at times will fail. Models are not a representation of the real world. And even if you have a successful quant model, over time, other quants can compete in that space and arbitrage away your alpha. A second fault of quant funds is many people think that they're a black box. There's a terrific book called Inside the Black Box, and the author of that says, no, the ultimate black box is right between our ears. It's when someone makes a discretionary call or a gut instinct to buy or sell a security. These algorithms are much more scientific in the approach of finding what positions to hold and how long to hold them. A third drawback of quantitative investment models is they are not that sensitive to regime change. You can go from a bull market to a bear market, sometimes in a snap, and many of these quant models are not that reactive to regime changes because they rely principally on historical numbers. A final drawback or potential drawback of a lot of quant strategies is the use of leverage. Leverage when the markets are going your direction are terrific. They magnify your gains. But if the markets are going against you, leverage cuts two ways. It's a double-edged sword. You might be forced to liquidate even very attractive positions to meet margin calls. In summary, I guess the $64 question for RIA channel viewers is, how do you get more information about this? I can recommend one real short read. It's by Man AHL, the prominent British firm. They've done a 6-page primer on how to pick a quantitative hedge fund. The kinds of lessons that are outlined in that would apply to a quantitative mutual fund as well. Knowing that, though, a quantitative mutual fund is not likely to have the amount of leverage that a quant hedge fund will. The second one is for those people who really want to delve into this topic, pick up a copy of Inside the Black Box by Rishi Narang. It's a 250-page book. What Rishi Narang does, his entire work, is allocating to quantitative investment strategies. So for those people who want to lift up the hood, understand more about quantitative investment strategies, I'd recommend that as well.